So, Bitcoin in 2025.
Right.
Okay, you didn't just hear this from us. The overwhelming consensus coming into the year was that this was it. This was the year.
The definitive year for the asset. Everyone was saying it.
Everything was lined up. You had supply, demand, regulation, even the macro picture. Our sources were calling it, I'm quoting here, the most anticipated trade of the entire cycle.
And yet, here we are, closing out the year, looking at research that details this massive surprise.
Yeah.
How this perfect setup ultimately just fizzled. And that disconnect, I mean, the huge gap between what everyone felt so certain about and what the price actually did. Well, that's why we have to do this deep dive.
That's the mission today. We're going to do a full autopsy of what looked like the perfect bull case. We need to look at the specific structural catalyst that built up this enormous bullish conviction.
The hype.
The massive unassailable hype. And then, using our source material, figure out precisely why these powerful narratives got completely overridden by, the cold, hard price action starting around Q3.
What the sources really give us is a brilliant tool for this. They force us to look at this head-to-head battle. On one side, you have the theoretical perfection of the fundamentals, ETFs, Fed policy, all the good news. And on the other, you have this current, much less forgiving technical picture as we head into 2026.
And the lesson is?
If you take away just one thing from all this, it's the harsh lesson the market taught us. Price action trumps headlines. It doesn't matter how good the story is.
Okay, so let's unpack that. Let's start with where the money was made, or at least where people thought it would be. This incredible bullish conviction.
Yeah.
I mean, the market's confidence, it wasn't just hope, right? It was built on three really dominant structural pillars.
There's some perfect synthesis, really.
It was structural demand, constrained supply,
Yeah.
and much better regulatory optics.
Yeah.
The perfect storm for what everyone thought would be this historic blow-off rally.
So let's spend a minute on that first pillar because it was huge. Institutional access, the ETFs.
The watershed moment.
Exactly. The moment the U.S. spot ETFs got approved early in the year, that's what everyone called it, a watershed moment, universally.
And it really was, wasn't it? It wasn't just about unlocking regulated exposure. It created this whole new, efficient pipeline for capital.
From huge wirehouses, institutional portfolio managers.
And when you saw the follow-through, especially those massive inflows into BlackRock's IBID, wow, the narrative just kept getting reinforced.
Structural demand meeting constrained supply.
The only possible outcome, everyone thought, was higher prices.
And that demand wasn't just heavy, it was relentless. And if you needed that final confirmation that the big fish were really in the pool, the source specifically highlights Vanguard.
Right, Vanguard's move to allow its massive client base access.
And Vanguard is famously conservative, right? They're all about the long term. So their participation was seen as a definitive game changer. It just added this insurmountable strength to the institutional adoption case.
Which flows perfectly into Pillar 2, the macro environment. This was supposed to be the wind in the market's sails. The universal expectation was for a Federal Reserve pivot.
A pivot away from tight money towards rate cuts and looser financial conditions. That was the catalyst everyone was banking on.
And that's where the story really gained incredible velocity.
It did, because that shift was basically read as a signal to, dump cash and rotate into risk assets.
And Bitcoin being the ultimate risk asset.
It was expected to be the main beneficiary. You have to think about the two forces at play there.
Right.
You had the expectation of a weaker dollar because the Fed was easing, and at the same time, all this liquidity flowing back into the system.
And the sources are quick to note that liquidity was also being fueled by persistent fiscal deficits. The government just kept spending.
Right, which drove a swelling money supply. The whole environment was basically tailor-made for an asset like Bitcoin, which people see as a hedge against all that.
A hedge against fiat devaluation.
Yeah.
It was like digital caffeine for the markets.
Exactly. So the macro picture just added fuel to the fire that the institutional inflows had already started, and then you layer on top of that Pillar 3.
Regulatory clarity and the supply constraints. So on the regulatory side, we had the U.S. administration pushing through the Genius Act. Now, that sounds like some kind of bureaucratic cleanup, but what did it actually do that was so important for the bulls?
Oh, it was way more than just housekeeping. It was about legitimacy. and liability.
Okay.
The core of the Genius Act gave these specific, clear liability frameworks so that federally regulated banks could actually hold and safeguard digital assets for their clients.
So it took them out of that legal gray area.
Completely. It fundamentally legitimized the idea of custody for major institutions. It was like the final stamp of approval, which just reinforced Pillar 1 all over again.
So you've just legalized the custody and the flow of capital through giants like Vanguard and BlackRock. And at the exact same time, you have the supply constraints. We can't forget the April halving,
which successfully tightened the new supply from miners coming onto the market. Right.
So let's just recap that perfect alignment. You have institutional demand surging and validated. You have the Fed pivoting towards easier money. You have regulatory certainty finally locked in. And the new supply is literally cut in half.
An unstoppable bull run was the only logical conclusion. The expectation was just maximal.
It was.
And that maximum hype is exactly what sets up our second segment, the surprise ending. Because despite all of those certainties, the script just completely flipped.
Yeah, the sources use that great sporting analogy, right? Calling 2025 a tale of two halves.
It was startling. I mean, BTC delivered it first. It ripped higher between April and July, hit new all-time highs.
It was fulfilling the narrative perfectly, but then the momentum just... it vanished.
It stalled.
It stalled repeatedly above that critical $123,000 zone. And despite more good news, more ETF inflows, the Fed talking softer, it just could not punch through that ceiling and hold it.
Why that number? Why 123,000? Was that just a random high point, or was there something specific about that level? Oh, it was far from accidental. It was a dual threat.
Okay.
Psychologically, sure, it's a big historical milestone. But technically, our sources identify it as the high watermark from the last bull cycle's very frothy blow off top.
So history was repeating.
Well, when a market fails to get over such a specific, historically validated resistance level, even with all that BlackRock and Vanguard money flowing in, that is your first huge sign that the narrative's strength is being overestimated.
And it just faltered dramatically in that final quarter. That's the key observation here.
It defied consensus.
And in doing so, it exposed what the source calls the fragility of narrative-driven positioning. We were all so focused on the why that we just ignored the what.
And that failure, that massive gap between the perfect fundamentals and the actual performance, that's what the sources are calling the biggest surprise of 2025.
And the biggest lesson.
It delivers the key harsh lesson for everyone going into 2026. No matter how compelling the story is, respecting the tape, the actual price action is the ultimate discipline in trading. Hype does not automatically equal performance.
Which means we have to stop talking about the headlines now and dive deep into what the tape, what the charts are actually telling us right now at the end of December 2025.
We have to.
Because the sources are very clear on this. As the year ends, the technical picture looks far less forgiving.
It absolutely does. And the main warning sign is the specific pattern the price is coiling up in right now. Bitcoin is consolidating inside a rising wedge formation. And this is happening after a pretty extended downtrend.
Okay, so for those of you who might not look at charts every day, what is a rising wedge telling us? What's the story there?
Think of it like a pressure cooker, but one where the buyers are kind of losing their enthusiasm. So the price is technically still rising, but the peaks are getting closer together, the range is tightening, volume is usually dropping off. And because this pattern showed up after a downtrend,
it signals continuation.
It's a classic setup that warns of trend continuation. The market is signaling that the prior move, the downward push, is probably going to resume when this pattern finally breaks.
And that's exactly where we are. The price is resting, maybe a little precariously, against a short-term uptrend line from November, if that line breaks.
It suggests the bulls have officially run out of steam against that overhead resistance,
Yeah.
and the door just swings wide open for another potential wave of selling.
The market's waiting for that confirmation.
Yeah.
So we need to get specific about the levels. If this bearish setup does materialize, what are the critical downside targets everyone needs to be watching?
The sources map out the sequence very clearly. If that immediate November uptrend fails, your first major target is a retest of the 21 November low.
Which is at?
$80,540. That's the immediate psychological and technical level the bears are going to aim for.
And if that $80,000 support fails?
Then the targets drop lower pretty quickly, confirming a more serious correction is underway. Next up, traders are watching the 2025 year-to-date low, which is around $74,500.
That sounds critical. A breach there would undermine the whole rally from the start of the year.
It would. And if we break below that, Then you're looking at a crucial historical inflection point. The March 2024 high of $73,800.
Oof.
A failure there would put serious pressure on all those long-term institutional holders who bought heavily in that range, and that could trigger even deeper technical selling.
Okay, so that gives us a very clear, if a little scary, picture of the downside risk. But what has to happen for this whole bearish setup to be wrong? What does an upside break look like?
To invalidate all this, BTC needs a really definitive push above the downtrend line that started back in October from the record highs.
That's the first hurdle.
It is, but the levels after that are just as important to confirm any real bullish strength. We'd need to see the price conquer some key moving averages.
Which ones are we watching right now?
First, the 50-day moving average. It's sitting right around $99,060. A solid hold above the 50-day would restore some short-term momentum.
And longer.
Beyond that, it's always the 200-day moving average. That's a huge inflection point for long-term market health. Reclaiming that would be a major signal of recovery.
And what's the ultimate resistance level we should have on our radar?
If the 200-day is conquered, the ultimate resistance that would suggest the bulls are really back in control is $107,500. A move above all of those levels would be a strong sign that the rising wedge failed and the fundamentals are finally taking over again.
Now, beyond just that price pattern, the source also points to a couple of key technical oscillators, the RSI and the MACD, that are kind of confirming this building bearish pressure.
They are.
What are those indicators telling us?
The RSI 14, which basically measures the speed and change of price moves, has already broken its own little uptrend, and it's now clearly moving away from that neutral 50 level. In the source's language, this is favoring bearish setups. It tells you the buying velocity is just fading away relative to the selling pressure.
And the MACD.
The MACD is a momentum indicator. It's great for spotting trend shifts. Now, it hasn't given a confirmed sell signal just yet, but it is, and I'm quoting again, curling over towards the signal line. This closeness to a negative crossover suggests that negative momentum is building. If that crossover actually happens, it would significantly strengthen the bearish signal from the price pattern itself.
It is just stunning how quickly experienced analysts will drop the front page headlines, the ETF inflows, the Fed pivot, and shift their entire focus to pattern recognition when the price doesn't deliver.
Yeah.
The conversation instantly shifts to a rising wedge, that $80,000 low, and a McDeach crossover.
Yeah.
That agility, that ability to pivot from the story to the stats, that feels like the real insight here.
That's the core lesson from 2025. While the year gave us all this clear evidence of incredibly powerful underlying catalysts, the price action at the end of the year is a reminder that you always have to respect the market's internal rhythm. The price action, the charts, the tape. You have to respect it no matter how strong the fundamental story seems. Narratives set the stage, but price action writes the script.
So what does this all mean for you as you're processing this information heading into the new year? The source material actually has a section titled Mixed Outlook Augurs for shorter-term trades in its 2026 outlook.
And that's key.
Because if the market is actively defying these massive structural catalysts like ETF inflows, it forces a strategic shift for everyone.
It really raises a profound question about investor psychology and, frankly, discipline. If that powerful long-term story, the easy buy and hold narrative, is failing to immediately translate into higher prices, how does that change your strategy?
Right. Does it force you to move away from pure conviction and more toward technical discipline, tighter stop losses, shorter time frames? So how do you, the listener, balance that inherent conflict between the long-term vision of structural adoption that promises this huge upside and the harsh, unforgiving reality of the short-term tape that's signaling caution right now? That's the tension we'll leave you with as you integrate the surprising lessons of 2025.